Hey everyone, it's Larry Kotlikoff back with Economics Matters, the podcast. I'm delighted to talk to you today about investing. Uh, so I wanted to demo for you my company's full risk investing analysis, which is I'm not going to be giving any financial advice, any recommendations by this stock, invest this way, beat the market, go save, whatever you want to do, you get to explore in our software. It's an educational tool. Uh, we're not registered investment advisors. I'm just a PhD in economics. Uh, and I think I know a bit about the subject, and maybe more than people that haven't worked on it for decades and written articles in finance journals. So I think I have a very strong background to talk to you about this, even if I don't have a certified financial planner certificate or a registered investment advisor certificate. But I'm not, again, not giving you investment or financial advice, just giving you some education for free. And I hope that this is of value and that you'll look at our other podcasts and sign up for a lifetime subscription with larrykotlikoff.substack.com. If you want a lifetime free subscription, if you may have a short-term subscription, you can just email me at kotlikoff@gmail.com. Send me all the emails of all your relatives who'd like to have free lifetime subscriptions. I'm trying to really build this subscriber list up into the millions if possible. Obviously, we're not anywhere near there, but that's the goal. And primarily, I'd love to have high school students be able to, have access to this. So if you know a zillion high school students, just put them all together, their email addresses in a Excel file or a Word doc or whatever, or just an email list, and send me the whole list. Maybe you're a high school teacher. Anyway, to get on with the show here, let me share my screen, and I'm going to get rid of this guy that's rather annoying. And I'm going to get rid of this guy. What happened to my little Excel spreadsheet? Okay, so get rid of that guy, and here we are. I want to look at this. Okay, so what I've done is started a case in our software, which is MaxiFi.com. This is the website, MaxiFi.com. We have all kinds of press reviews and learning center for how you can learn about this software, case studies, articles that tell you about economics-based financial planning. That's the key thing, that this is not conventional financial planning, but economics-based planning. Our goal is to help people make economic decisions that accord with what economics recommends. It's not to try and sell you anything. Our software doesn't come with any sales pitch apart from selling the software. We're not trying to sell you product. And I think when you start trying to sell product and give investment and financial planning advice, you start running into a conflict of interest, which is very serious and can be very dangerous for people that go that route of using conventional tools, or advisors that use conventional tools. But anyway, economics is about it's about reality. It's about living within your means, trying to raise your means by optimizing your lifetime Social Security benefits, minimizing your lifetime taxes, doing things like maybe downsizing your home when you retire, moving to a state where there's no income tax or lower income tax, working longer, switching jobs to a better job. All these things can be analyzed in this tool, MaxiFi Planner, MaxiFi .com. And you can also, make decisions about, can I really afford that a sailboat, the 30-foot sailboat that I've been dying to buy. What will that do in terms of lowering my living standard on an ongoing basis? By that, I mean my discretionary spending per household member. So anyway, I ran a case here that I'm going to show you, which is a guy named Jim Jones. He's 60. It's really simple. He's retired last year. He has no Social Security earnings strategy. His strategy, because he has no Social Security earnings record. The only thing about Jim, financially speaking, is that he has regular assets of $5 million. So this is the simplest case I can set up for you. He's got no retirement accounts. He's got no Social Security benefits coming in. He's just got $5 million that is not in an IRA. He's not working, and he's living in Alaska and paying $1 of rent, which means that I'm just looking at all the money that I'm just basically taking the housing out of the picture here, and the taxes, because Alaska doesn't have any taxes, out of the picture. And the base assumption is that he can earn 2% real, apart from inflation. He can earn 4.25 nominal on his regular assets, and the inflation rate, I'm assuming, is 2.25, so that's a 2 percentage point difference. And that's what you can earn in buying long-term tips or even short-term tips these days. Tips are inflation index bonds. So anyway, if we just run his case, we have deterministic planning, which is right here. You can run a plan and then maximize it. You can add additional plans. You can copy the original plan just by going up here and say add a new profile to copy the old profile. You can give it a new name, and then you can modify it. So anyway, if we run his basic plan, which I did a moment ago, here's what you see, that if he were just to invest in inflation index bonds, and inflation turns out to be what is projected by the market over time, about 2.25. So he's not facing very high taxes on those tips, which would arise because the inflation kicker that is protecting us against inflation is not protecting us against extra taxes, because the inflation protection is subject to taxation. So if inflation's 10%, our coupon payments go up by 10% on our tips, then we have to pay taxes on that extra 10% right away, even though we may not be cashing in the tips for decades. That's if we have the money in a taxable regular asset account, which is the assumption here. So anyway, if he does that and all the assumptions turn out as entered, he gets to spend $152,401 every year in today's dollars right through age 100, because we're planning very carefully, and that's consumption smoothing. He's single. There's no kids, no wife. So this is consumption smoothing. We could obviously put in special expenses for larger medical expenses later in life, and that would lower his discretionary spending. Those would be viewed as fixed expenses. These are, basically covering, well, let's just see what his spending on fixed expenses references. Obviously, there's very little housing. He's got some Medicare Part B premiums, which are small. He does have some taxes that are the main element of his fixed spending. We got like 41K here. So he's got taxes through time. As he runs down his assets, his taxes fall. Anyway, back to the baseboard, the dashboard. You see his lifetime balance sheet. You see that we're spending on the fixed spending and on his discretionary spending only what he has available to him in lifetime resources. So that's one of the hallmarks of economics-based planning. It's not saying asking you what you'd like to spend and then trying to put you into risky assets in order to meet that target. We just say, hey, to start with, what have you got in resources? We'll figure out a lifetime balance sheet, and we'll figure out what your off the top spending is, and the rest is discretionary spending. But we're going to allocate the discretionary spending in a way that your living standard is perfectly smooth. And in this case, it's at 152,401 per year. That's your discretionary spending. And if you're single, it's also your living standard per adult. And that's consumption smoothing. That's what squirrels do. Squirrels don't when it's springtime, I don't know any squirrel that comes out and says, I'd like to have in the winter, I'd like to consume 5,000 acorns a day because that's my goal. That's my plan. That's my target. I'd like to spend that many, I'd like to consume that many. And all I have to do is somehow miraculously come up with enough acorns, collect enough of those to be able to eat 5,000 a day. And of course, no squirrel would do that. They're not ridiculous. They're not stupid. They just realize that they can only spend and they can only consume the acorns they can collect. And that's not an enormous amount. So that's what economics planning is about. It's about reality. And within that reality, you can do things like, as I said, raise your discretionary spending by reducing your lifetime taxes with retirement accounts, with moving to states that don't have high taxes, by raising your lifetime benefits. But we're not talking about that today. What we're going to talk about today is these other reports, which are the stochastic reports. In particular, I want to focus on this full risk investing report. I already did a podcast about upside investing, but I'm just going to show you what upside investing produces for Joe here. And in upside investing, let me just review really quickly. When you click on that, he's asked to enter how much of his regular assets, the 5 million, he wants to put into risky assets, which in this program, it's in this particular report, it's investing in the S&P 500. The rest of the funds are assumed to be earning 2% real and tips or some other safe security. And then if we hit continue, the program will run and we will see the reports. But I've already run it so I can just show you the result. The result is that if all of his stocks go to hell, they're lost entirely, then our person here, I just want to double check I'm not misstating. Yeah, it's Jim. I said Joe, right? So Jim would be able to spend $109,000 given the assumptions every year. That's a whole lot less than the 150 or so that he would be able to spend if he put everything into tips. So that's his basic living standard floor, because with upside investing, he doesn't spend out of anything ever unless it's been made safe, unless it's been put into tips or some other safe security. So he treats the stocks as gone until they're found, lost until they're found. And that's his basic underlying floor. But there are, with most high probability, his 50K or so, let's see, he's putting 30%. So he's putting about 1.5 million in stocks with very high probability. Those are not going to go completely down the tube. So he's proposing in his inputs to wait 20 years and then gradually over 10 years divest himself of stocks and by every year take out a tenth and then a ninth and then an eighth of his stocks, sell them off at the market value, and then convert them into tips. And then he's able to raise his living standard floor. So for the next 10 years, you can see under these different trajectories, his living standard goes up. And then after he's converted everything, it stays flat because he's entirely in tips. And we're assuming that the conversion can be done also with this 2% real return, which might be a little optimistic because the return could go back down, but that's probably a improvement in the program that we need to add. But anyway, under this under the version of the tool we've got right now, this green curve is if you take all the 500 trajectories that we ran of him investing, not spending out of any of the stocks until he starts converting, and then converting based on how well the stocks have done. The green line is the case where the trajectory where his average living standard across this entire period from age 60 to age 100, 40 years, the average living standard per year is the 95th highest. And this black dark curve here is down here at the bottom is the 5th highest average living standard. The blue is the median, the 50th highest living standard. So you can see that, his basic living standard is only 109,000, but half the time, once he's done all the conversions, he's going to be able to spend from age 80. So he's going to wait 80 for 20 years from age 80 on. He'd be able to spend at 319,000, which is basically 3 times higher. If he did super well and was in the 95th percentile, his spending would be up to 700,000. Now, this guy Jim's a single person. Why would he want to spend so much later in life? He could also start converting earlier, maybe at age 70, not at age 80, and maybe convert over a shorter period of time. But maybe he has kids, or maybe he has a charity that he wants to give money to. Maybe it's kids, he doesn't have any disabled kids or any young kids right now. So that's the assumption of the program. But he might have a niece or a nephew, maybe he's never married, or he might have a charity that he wants to contribute to. And he might be quite happy spending just 109,000. Maybe that's even more than he's currently spending right now. He might be living very frugally. So that's upside investing, and you get to see all the statistics about it, and you can go back and change the inputs and put in less. The interesting thing is how much upside you can have by putting in a relatively small fraction of your assets in the market. During this whole period, he's just letting his stocks accumulate. He's not taking anything out, so he's not being hit by a sequence of return risk where that references taking money out like the day before the stock market booms. And you've missed out on the high return because you have taken money out the day before. So that's the sequence of return. Exactly what sequence the returns come determines how much money you have. But with any given trajectory of outcomes, there's no the sequence between here and here, the returns doesn't matter. They just all accumulate multiplicatively to produce whatever value of the stocks there are under the particular Monte Carlo simulation. Again, there are 500 of them. And this green one is one where he has a huge pile of money that he's got in that stock account, and he starts taking it out and gradually taking it out. And each time he takes it out, he's taking out a pretty big sum. And then through time, the market is continuing to do well, and he's taking out more and more. And then he's taking it all out, and he's living at this, along the way, he's living better and better every year. And then he gets to spend 700,000 a year, and maybe he's only consuming 100,000 for himself, or 109,000, but giving the rest basically 600,000 to charity a year for the rest of his life, which is something a lot of people like to do. Okay, so that's the upside investing. I told you about that in a prior uh, podcast. Now, the full risk investing is making a different assumption. It's saying, let's consider Jim here spending out of all his assets, not just the safe assets, but also the ones that are invested in TIPS or some other safe asset. And we're assuming the government doesn't default. So when I say TIPS are safe, I'm assuming the US government doesn't default. The US government is pretty broke. So there's always that chance. And I don't want to claim TIPS are perfectly safe. I already told you they're risky with respect to inflation on the tax side. And they're also subject to default. A lot of countries over time have gotten into trouble. Our country is on a bad fiscal trajectory. We have politicians who are not talking about fixing it. We're going to have a debate tomorrow night between the two presidential candidates. Neither of them is going to mention at all the enormous fiscal gap our country's running. But anyway, so full risk investing says, well, let's, if you want, compare the current strategy, which for Jim is putting his assets 50-50 into stocks and bonds. And he wants to compare those with a safe strategy, which is he's chosen a 20-80 portfolio to investment strategy through time to compare with, and also a risky strategy, which is 80-20. Now, he doesn't have any retirement accounts, so there's no retirement account investment strategy. Otherwise, there would be. And just to be clear, Jim can create whatever investment strategy he wants just by clicking on this button. We have some canned strategies like this 50-50 stocks bonds, which says that during these intervals, he's going to be holding, and you can set these intervals to, in the program, you can change these ages. Obviously, he's not 44 anymore. He's 60, but he's basically going to hold 50-50 the rest of his life. But you can set up a strategy where he holds, maybe suppose he was at age 44, he might be holding 80% in stocks and 20% in bonds, and then gradually through time have that percentage that's in stock go down to maybe 20-80. That might be like his own life cycle, homemade life cycle fund. And that's perfectly doable in this. You can just customize and set up your own investment strategy and change those ages at which you change things, and also change what you are holding during the intervals. And then you can also choose whatever assets you'd like. So we have some dimensional fund assets in here, but we don't actually, they're just there because we have a bunch of financial planners who use those. Dimensional fund doesn't pay us a penny for including these, and any investment company that wanted us to include their funds, they can get in touch with us, and we'd be happy to do that. They'd have to provide us with the data to do that, and we would, but we can get these data right from the internet. And then we also have canned assets like large cap stocks. It's the S&P 500. These different assets that are available, whose return histories are available online. They're in the public domain. And then you can also create your own asset, give it a name, describe it, and then you enter a return history. We need to have at least 10 years of return histories for you to enter your own asset. And then you can make a investment strategy with your own assets and with other assets like the S&P, maybe the Morgan Stanley bond, some kind of a bond index that we have available as one of the default assets. So, but right now I'm just using these default assets, and I ran the report, and the report assumes, I'm just going to show you the report assumes that Jim is going to spend cautiously through time out of all his assets, not just out of his safe assets, but out of all his assets. But he's going to do so on the basis of assuming that he's going to consume as if he was going to earn 2% for sure, but nothing more, nothing less for the rest of his life on all his assets. So that's his consumption behavior. And here's the report that we're getting out. And what we can see is in these gray bars is what he would be spending if he didn't do any of this full risk investing. He didn't do upside investing. He just put everything he has in safe assets that are yielding 2%. He'd get to spend, that's showing just the base plan, the 152,000. Those are the gray bars, the heights of those. But now what I'm showing here is under the different investment strategies, what things would look like in terms of trajectories if he did poorly. So these are very poor trajectories. These are like the fifth lowest trajectories that are being generated. So with the risky strategy, which is 80% stock, 20% bonds the rest of his life, if he, on average, across all the future years, 40 years, has his average living standard, where he's adjusting every year based on how well he's doing. So that's why these trajectories are going up and down, because here he's done pretty poorly. So he has less money, and if he spends cautiously, he only gets to spend in that year under this risky strategy $84,000, not the 152 that he would have been able to spend had he just invested everything in the safe assets. But there's some real downside risk here. It's 84,000. And that's not the worst case scenario. This looks to be the worst case scenario in that trajectory, which is getting to spend only 70,000. And that's basically less than half of what he would otherwise have been able to spend had he invested just in safe assets. Now, if he does, if he were to have followed the safe strategy, 20% bonds, 80% stock, that's going to give us this blue curve, which is and he would have not done with the same return outcomes in stocks and bonds. He'd be able to, he would not have lost so much money over time, and he would be able to spend 124,000, which is still not as good as the strategy of the base plan. So actually, I should have been. I'm misreading this. The current, the safe strategy is here. The current strategy, 50-50 stocks and bonds, is actually up here. So so sometimes you get even in bad outcomes, you have years in which having invested more aggressively, you can do better than having invested less aggressively. But you can see that the more aggressive current strategy, 50-50 rather than 20-80 in stocks versus bonds, so that has more downside years compared to worse years compared to the 50-50 strategy. So all this makes a lot of intuitive sense. You get to see, hey, if I invest at risk, what's going to happen to my living standard? If I invest in risk and I still spend conservatively through time, but I spend out of all these things, all the assets I have, including the stocks, which are not safe, and even bonds, conventional bonds, which is, we're not talking about buying tips here. We're talking about investing in a portfolio of conventional bonds, index portfolio. They're not safe either. So, so this is what happens if you invest and spend out of everything in a risky manner. But here's the upside, the good side of this story, which is if you do very well, if you have 95th percentile average living standard outcomes then look how good the upside is. Having invested in a very risky way, I'm going to be able to spend in this year not 152,000, which is my base plan, where I don't invest at all in anything risky, but I get to invest, get to spend basically about 3 times more, or 4 times more actually. $600,000 is my living standard. But you can see that even if I do well, there's some ups and downs. I can, I'm spending at that level, and then I continue spending cautiously, but the market doesn't always turn out well. There are years where it randomly does poorly, even though the average return on the stock market is quite high historically in real terms, and everything we're presenting here is in real dollars, and we're looking at real returns, not nominal returns. We're adjusting for inflation. And you see that there is, things you're taking on fluctuations in your annual living standard if you invest this way. What you don't want to do is what conventional planning says to do, which is it tells you in many cases to invest at risk, maybe put 80% into stocks and 20% into bond, or even 50-50. And that 50-50 would be the current strategy, but it says maintain your spending in retirement independent of how well the stock market does, or the bond market does, if that's also risky. As I said, less risky, but still risky. And that subjects you to much more sequence of return risk, because you're taking money out for sure, even though the market has just tanked, and you're taking the same amount out that you did last year and spending the same amount. And then the next year, the stock market goes up and you've got less money left to go up because you've taken it out. That's pure sequence of return risk. So that's really, it's almost maximizing your sequence of return risk. That's what conventional financial planning, which is of course approved by FINRA and the SEC. They regulate brokers and RIAs, I think inappropriately, but they do that. I think this goes against fiduciary, a reasonable fiduciary standard to let you experience that much risk. But this is saying, look, your life is going to be risky if you spend out of all your risky assets before they've been converted into safe assets, or if you never convert them into safe assets. So you're in for a ride, and it could be a good ride or a bad ride. And how much you want to invest in safe versus risky assets, well, we have a means of helping you understand that. And again, this is not investment advice. This is just letting you explore what economics has to say about the outcomes, let you see the outcomes that you might experience. And then here in this, what we call the comfort index, we calculate for what economists take as typical kind of preferences about consuming a lot versus consuming a little, how much happier we are. And that's called utility, annual happiness. And if you're kind of risk averse, if you're very risk averse, that means that translates in terms of this mathematical function into being much less happy if you have a loss in your spending versus in other words, the absolute loss in your happiness and your utility in the mathematical formula for your happiness is much bigger than the same for the same size absolute increase in your spending, how big the increase in your utility is. So what's really going on here is if you're, let's say, you love steak and you're having 2 steaks for dinner, well, you're going to be a lot more unhappy in absolute terms if now the waiter comes around and says, well, the steak is spoiled, so you get to consume no steaks tonight, versus the waiter comes over and says, we've got some extra steaks, got 30 extra stakes and, or maybe 2 extra stakes, and here they are. And now you get to consume 4 stakes rather than 0 stakes. Well, the extra 2 stakes don't make you, the increase in happiness is not as big as the decrease in happiness from ending up consuming nothing as opposed to 2. So that's what risk aversion is about. And if you're moderately risk averse, based on what economists would call moderate risk aversion, a parameter in this mathematical function, we can compare your the well-being, your lifetime outcome, lifetime average utility. We look at all the trajectories of your how much steak you get to eat every year along all these different 500 paths where you're spending out of all your assets, but also cautiously. We figure out your lifetime happiness under the 500 paths. We take the average of those 500 lifetime happinesses, and then we compare them. And you can see that if you have moderate risk aversion, the safe strategy would look the best, to have the highest index value here. This risky strategy would look like 24% worse. Now, what do I mean by 24% worse? It means the way we're comparing these two things is to say, well, if you had moderate risk aversion, if you're Jim, you have moderate risk aversion, and you were forced to invest in the risky strategy, that would be like investing in your current strategy, which is 50-50 stocks and bonds, but consuming 24% less in every eventuality, in every situation that arises. If the stock market does well or poorly, the bond market does well or poorly, your happiness from being forced to your average lifetime happiness from sitting here right now at age 60 and being forced to invest 80-20 for the rest of your life, that would be like investing 50-50, but then in every outcome, getting to consume 24% less. That's obviously a big difference. And so the risky strategy, if you're moderately risk averse, is a whole lot worse than the current strategy, and it's even worse than the safe strategy. If you're very risk averse, look how badly the risky strategy does. You can tolerate almost no risk. And we, by the way, can describe in more detail exactly the what's going on here in terms of what the comfort index is about. So we have a discussion of it. And what about if you can tolerate a lot of risk? Well, then the risky strategy is about 4% better than the current strategy, and the safe strategy is about 11% worse. So it's like, if I were forced to hold 20-80 stocks and bonds, that would be like my average happiness sitting here at age 60 would be like being able to invest 50-50, but then no matter what happens, somebody grabs 11% of my stake and takes it away. That's what it's going to feel like. So I hope you've gotten a sense of full risk investing. The reason we're adjusting these trajectories, maybe these are the median trajectories every year, is that you're always spending cautiously, but you don't sit there and just let things go on autopilot like conventional planning assumes, some 4% rule or I'm just going to spend 80% of my pre-retirement income. That's my replacement rate. I'm just going to spend that no matter what happens. And meanwhile, my investment advisors put me, into a portfolio that he's sure is going to beat the market, and is charging me 1 or 2 percentage points of my assets. And gee, it doesn't work out, but I've been spending for years at this high level, 80% of my pre-retirement income, which was a target that was way too high to begin with that he set me up with. And now I can go broke, because that's one of the things that happens in conventional planning. They allow you to go broke. Whereas in economics-based planning, our tool, we say, look, even if you're investing in a risky way, we're going to have you cut back your spending if the market does poorly. And that's why you see, if it does very poorly, that this person, Jim, is adjusting downward their spending, but they don't end up spending nothing. That's what it means to go broke, to have nothing, to be living on cat food, even though you started with 5 million bucks to begin with. So I think that conventional planning is extremely dangerous on the investment side. I think economics-based planning makes perfect common sense. It's what a squirrel would do. I don't think conventional planning is smart enough to be used by, is good enough to be used by squirrels, let alone human beings. And that's pretty strong language. But and then I just want to end this podcast with repeating that I'm not giving investment advice. I'm not telling you to do upside investing or full risk investing, or put 20% in stocks and 80% in bonds, or assume that you have moderate or risk tolerance. All that is up for you to think about and decide. Just to use this tool to help you see what would come out if you were to engage in these behaviors, this investment strategy through time, this spending strategy through time, and if you had these degrees of risk aversion, how it would look. That's what a learning tool is about, but it's not telling you exactly what to do, because we think that people should be able to see the implications of what they are doing, potential implications, but then come to their own decision. That's the entire reason we created the software, going back now 31 years. So thank you very much for attending this podcast. Please tell everybody you know about MaxiFi.com, MaxiFi Planner. It's a great tool that thousands of people have been using over the years, and it will help everybody, no matter what their situation is in life, whether they're poor or super rich, or old or young, or trying to choose a career, trying to choose a job, or choose between jobs, trying to decide whether or not to buy this size house or that size house, whether to downsize, whether they can afford an extra child, whether to get divorced. The tool can be used for basically any question whatsoever in personal finance. So let me just leave it all there, and I will stop the show.